Hi, everybody. We're going to give it one more minute before we start. This is just to see if we have any more stragglers coming in.
Hello, Winnie. Can we wait
Yes,
more minutes? Yeah, waiting for agent. I will
sure.
notice them in the WeChat. Yes.
Okay, no problem. I can wait a little longer.
Thank you.
Sure, no problem.
Hello, Winnie.
Yes, I'm here.
Yeah. Can we start now? I
Sure,
think maybe some agent will join later. Then.
sure. No problem. No problem. I
Thank
will
you.
start. Yeah, absolutely. Absolutely. All right. Let me put this down on my end. Hi, everybody. My name is Wei Ming, and I am with Asset Preservation Inc. We are a 1031 exchange company, often referred to as a qualified intermediary or 1031 exchange facilitator. Now, the only thing we do for clients are 1031 exchanges. And today we are going to go over some of the information on a 1031 exchange, how a client can execute an exchange, what they need to know about an exchange before they start, and many more. Now, before we dive into it, let me give everybody a disclaimer. I'm not a CPA, nor am I a financial advisor or a tax advisor. The information I provide here today, they are more general information. For example, let's say an average capital gains taxes. I do not know a client's specific tax rate. They can always ask their CPA or tax advisor to help them calculate that exact number. But the information I give is more of a general information or an average numbers. Now, diving straight into a 1031 exchange, what does the Internal Revenue Code say for the 1031 exchange? It says no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment if such real property is exchanged solely for real property of like kind, which is to be held either for productive use in a trade or business or for investment. To be honest, I don't really like reading this. I don't really like saying it too often because it's very confusing for a lot of people. If you're not a tax professional, or if you're not an attorney, this may seem very confusing. But what it basically says about 1031 exchanges is if you have a property you're using for investment or business use or even trade use, if you sell that and buy another property like it, you can defer up to 100% of your capital gains taxes. So for an investor, for your clients, what they are doing is they are essentially moving equity from one property to another without having to pay the taxes yet. Now, today, ladies and gentlemen, we're going to be talking about a number of things. I may be able to talk about split treatments if that is possible, if I have the time. What is a split treatment? Well, what if a client is renting out a part of a property and also living in it? Can they qualify for a 1031 exchange? Answer is yes, and maybe even more than that. If you are a real estate agent, you may have heard of the homeowner's exclusion. It says if your client has lived in the property for 2 out of the last 5 years, they are able to claim up to $250,000 tax-free if they're single, $500,000 if they are married. And again, split treatment refers to using both the homeowner's exclusion and the 1031 exchange. Now, we can also discuss just for a little bit a natural disaster. What does natural disasters do for clients when they are doing a 1031 exchange? Well, if it impacts a lot of individuals or a large area, the IRS may issue extensions for a client's 1031 exchange. We'll go over that in just a little bit and see if any of your clients may be affected and how much of an extension they get. Now, we're going to be talking about the different types of exchanges that your client can use and what to keep in mind if they want to do a successful or have a successful 1031 exchange. I'm going to be talking about some issues and solutions that a client may face, and I will be answering any questions that you may have at the end of the presentation. Now, ladies and gentlemen, I guarantee you most of your questions will be answered by the information in my slides. However, if there are any unanswered questions that you may have, please feel free to ask me at the end of the presentation so that I can keep the flow of the presentation going and be mindful of everybody's time. Now, ladies and gentlemen, here is one of the biggest reasons why, some of the reasons why an exchanger will consider a 1031 exchange. A 1031 exchange can be used to defer up to 100% of a client's capital gains tax liability. Now, if I sell a property and let's say I have $100,000 capital gains, normally I would pay taxes on that $100,000. Let's just say, for example, my tax rate is 33%. That's a $33,000 tax bill. By doing a 1031 exchange, I can instead use all of that money to buy myself the next investment property for me. In doing so, what I have essentially done is I basically told Uncle Sam, I owe you $33,000, but let me give you an IOU. In the meantime, I'm going to use all of this money. I'm going to buy myself more real estate, buy myself better real estate, and it works for me. Because if I buy more expensive property, I can rent it out for more and I can make more money. Well, guess what? A lot of clients will ask me, Wei Ming, when do I pay this taxes back? Two things to consider. Number one, whenever I sell that property in the future and don't do a 1031 exchange, then I have to pay that tax. I have to pay Uncle Sam my IOU. Or number two, I can keep on doing 1031 exchanges and keep on deferring my taxes and keep on saying I owe you to Uncle Sam. So at the very end, when I pass away, when I die, whoever gets my properties, it could be my kids, whoever gets my properties don't have to pay any of the deferred taxes I have accumulated in my lifetime. So I can do exchanges for the next 10, 20, 30, 40 years. That $33,000, it could be 100, 200, $500,000 in the future. I could defer that much as I can from 1031 exchanges. And when I die, my kids don't have to pay any of that. Now, the second reason why investors do a 1031 exchange is it allows them to diversify their portfolio. What do I mean by that? Well, in a 1031 exchange, you can sell one property and you can buy more than one if you want to. You can sell multiple properties and buy one larger one if you want to. It's up to you. The best part about it, you can buy anywhere in the United States, any type of real estate. I'll give you an example. I can sell in San Jose or Palo Alto, let's say an expensive property. Use that money. I'll buy one residential and I'll buy one commercial property. Again, anywhere in the United States. Diversify my portfolio. The third reason I want to include is increasing cash flow. Now, I have a lot of clients who will come to me and say, Wei Ming, I bought my property 20, 30 years ago, whatever it is. The rental income I'm getting from this property is not very high. It's not fair market value. So that is a great incentive for you as a real estate agent to punch that in, is say, hey, I see that your property you bought for $100,000 is now $2 million. The rent you're collecting does not reflect $2 million. So what can you do? Well, you can either boot out the tenant somehow and then increase to fair market value for the rent, or you can sell that property, buy another one, and start at the top. Start whatever it may be. So that $2 million, sell that $2 million property, maybe buy another $2 million property and have tenants who are paying fair market value. Increase your cash flow however you like across multiple properties. The only restriction is you have to buy like kind property. This means if you sell in the United States, you have to buy real estate anywhere in the United States. So I understand you have a lot of Asian clients as well. They want to sell in the US and buy outside or vice versa. That does not work with a 1031 exchange. They sell outside US, they buy outside US. They sell in US, they buy in US. Last but not least is depreciation. Depreciation are typically for clients who may have owned and rented out their property for a long period of time. If you are an investor yourself, you may be familiar with depreciation. In short, it's simply a write-off against your income. Now, let's say, for example, I can take $10,000 of depreciation every year on my property, and I make, let's say, $100,000. That write-off, just in simple math term, would mean I am paying taxes on $90,000 instead of $100,000. So every year, your client can take depreciation until they can't take it anymore. Now, a residential property, you can depreciate for 27 and a half years, commercial property for 39 years. Now, this may be a little familiar to you for those, this may be familiar to you because it may have been on your real estate exams. Now, 27 and a half years for residential, 39 years for commercial. If a client has been depreciating or owned the property for longer than that, they may not have any more depreciation and may be looking to sell. What does this mean for you as a real estate agent? Well, it means if that property is residential, the closer they are to 27 and a half years, the more likely they are to sell it. Commercial properties would be at 39 years. So if you are working with a escrow company to pull up those information for absentee owners, that is a great search parameter. You can put 15 years, 20 years, whatever it may be. So if it's getting closer to 27 and a half, the closer it is, the more likely they are to sell. Now, here is one thing that I get on a daily basis is I get clients calling me and saying, Wei Ming, I am looking to sell my property. How much taxes do I owe? The real answer is I don't know. I do not know your client's financial situation. I do not need to know. However, I tell my clients if you are selling in California, your average is probably around 33%. Well, this is when the client goes, oh, wow, that's a lot. Wei Ming, I did some Google research. I find that I need to pay 15 or 20%. Why do you tell me that I have to pay about 33%? Well, here's why. When you look at capital gains taxes, oftentimes clients will find the federal amount that they need to pay, 15 or 20%. And this is usually when they stop doing their search. When people talk about capital gains taxes, it's actually referring to 4 taxes that it's making up of. You have depreciation recapture at 25%, federal tax at 15 or 20, net investment income or Obama at 3.8, and state tax in California is 9.3 to 13.3. I have 0 here because some states do have 0, like Florida and Texas, but unfortunately in California, that's 9.3 to 13.3. Now, if you add all these together, a blended average is about 33%. So this is a great incentive for your client to do a 1031 exchange as well. They look at it and say, oh, maybe 15% tax is not so bad. If my profit is 100,000, 15%, I can live with that. But when they hear it's probably closer to 33%, that's when they really consider a 1031 exchange. Now, for you real estate agents, ladies and gentlemen, why is a 1031 exchange important? Well, number one, it can help your client to defer up to 100% of their capital gains taxes. And number two, it can potentially make you a second transaction. Here's why. When you help a client sell their property initially to help them sell, when they consider a 1031 exchange to defer their taxes, they need to buy a replacement property. And if you mention this to them, you can say, hey, client, have you heard about 1031 exchange? It can help you to defer up to 100% of your capital gains taxes. Client says, oh, no, I haven't. Let me look into it. And if I want to do it, it says I have to buy another property. Can you, the real estate agent, help me to find another property to buy? And there you go. That can potentially help you to get that second transaction right away. Well, not right away, but almost right away. Now, ladies and gentlemen, let's take an example of what that actually looks like. Because I've been talking about 1031 exchanges. Let's see some actual examples. All right. So in this example, let's say I bought a property for $500,000. I've been renting it out for a number of years, and my CPA tells me I have depreciated for about $100,000. Now I go to Jerry and say, hey, Jerry, I want to sell my house and it needs a little work and needs a little improvement. And Jerry tells me, Wei Ming, we can do about $25,000 into this property, make it look nice, and then sell it. We're going to sell it and we're going to net $1 million. Why do we need these numbers? Because there are two things I'm trying to figure out when I'm looking at these numbers. Number one, I'm trying to find my adjusted basis. And with that information, I can find out roughly how much gain I have if I sell this property. And again, ladies and gentlemen, if I'm using an average of 33%, I can take a good guess at what my taxes potentially are. In this example, again, I bought for $500,000. Depreciation lowers it by $100,000, but the money I put into it to fix it up will increase that number, giving me an adjusted basis of $425. If I sell and net $1 million, I minus the $425, I will get a profit of about $575,000. In this example, my CPA did all the calculations for me, and it came out to about $197,000. That is very close to 33%. It is more than 33% by a little bit, but that could depend on what your tax brackets are and how much gains you have. Now, ladies and gentlemen, I understand that you are a real estate agent, and this is a lot of tax information. So what can you do for your client? You can give them this presentation. You can give them this link, and this link will go to our website with a tax calculator. This way, your client can put in their own numbers and get a good idea of how much taxes they are potentially paying. Now, if I look at this, if I sell a property and net $1 million, well, after I calculate everything, it comes out to about $197,000. That's a lot of money, right? That's a lot of money. If I am going to buy another property anyways, do I want to pay the $197,000, or do I want to use the full $1 million to buy myself that next property? More than likely, you want to use the full $1 million. You don't want to pay your taxes yet. So, ladies and gentlemen, again, this is the link to the calculator. I will be providing a copy of the slide to Stella, and she can forward you the slides if you request it from her. Ladies and gentlemen, let's talk about the types of exchanges that your client can use. The first one I want to talk about is called a simultaneous exchange. This used to be the only one your client can use when 1031 exchanges first started. It says you would have to close on the property you're selling and the one you're buying on the same day. Nowadays, that's extremely difficult. Closing both property on the same day, that takes a lot of work, a lot of coordination. I mean, I have clients that will still do it. Why? Well, because they might want the new property sooner. They might want to improve the new property sooner. They might want to use it for their business if they're buying commercial, for example, sooner. They might want to rent it to family sooner. A lot of times, I will also have clients who will buy properties near schools so that they can rent it to their kids, especially in college. Now, I understand this is extremely, well, not extremely, but this is more difficult to do, which is why most of my clients will do what's called a delayed exchange or a regular 1031 exchange. In a delayed exchange, you you will sell and close on the property you're selling, and then from the close of escrow, have 45 days to identify something new to buy, and a total of 180 days to close on the new property. This was difficult when there was very little inventory. Now, in that case, what would happen? A client would sell the property and then they are struggling potentially to find something to buy. Why would clients face this? Well, if there are very little inventory, or what happens if a client is selling an expensive property? They don't want to struggle to buy something new, which is why some clients may use a reverse 1031 exchange. The reverse exchange lets you buy the new property first, and then you have, from the close of escrow, 180 days to sell your property. Complete opposite, complete 180. You buy the new property first and then you sell. The fourth type of exchange is called a construction or improvement exchange. And in my opinion, it's the most versatile and also one of my favorites of the exchanges. The reason is it allows me, the exchanger, to use any of my money to improve or make any capital improvements on the replacement property. So remember, if I sold my property for $1 million, let's say I need to find a property for $1 million, just as an example. I go to Jerry and I say, hey, Jerry, can you find me a property for $1 million? He says, sure. I found you a property here for $1 million, but because I'm such a good agent, I got it down to $900,000. Well, I need to buy a property for $1 million. So is $900,000 going to work? Absolutely. I can buy that $900,000 property and use the rest of the money to fix up or to improve on that property. Last but not least, we have the reverse construction exchange. The reverse construction exchange lets me buy the new property first and start improving on it within that 180 days. Also within the 180 days, I have to sell my property as well. So it combines a reverse exchange and a construction exchange into one. Now, ladies and gentlemen, let's talk about the key points to a 1031 exchange. What do I need to keep in mind to have a successful 1031 exchange. 4 things to keep in mind. Number 1, property qualifications. Number 2, tax deferral. Number 3, timeline. Number 4, identification. In order to qualify for a 1031 exchange, you have to have used the property for business, investment, or trade use. How long? Well, some people will hear they need to rent it out for 1 year. Some people hear that they need to rent it out for 2 years. What is the correct answer? The correct answer is they both work. The reason why there's a discrepancy is it depends on how aggressive you want to be with a 1031 exchange. Can you do it in less than 1 year? Yes, you can, but that becomes a more aggressive exchange. What do I mean by more aggressive? It means the higher probability of getting disqualified if you get audited. So if you want a safer exchange, use it longer for business, investment, or trade use. The shorter it is, the more aggressive it is. As I also mentioned, it's for business, investment, or trade use properties, not for primary residence. However, if you rent out a part of your property, that part of the property will now qualify for an exchange. Not the portion you live in, but the portion you rent out. If you are a real estate agent with a home office, that home office portion qualifies for 1031 exchange. Do you rent out that ADU? That ADU qualifies for 1031 exchange. Do you rent out a room? Do you rent out the bottom half of your house, the top half of the house, any part of your house you rent out? That portion of the house now qualifies for a 1031 exchange. Again, you have to buy like-kind property, sell in the US, buy in the US. However, flips and development projects do not qualify for 1031 exchange. They are considered inventory and not eligible. Now, ladies and gentlemen, the second thing to keep in mind is, how do I defer all my taxes? In order to do so, I must invest all the cash proceeds and acquire a property of equal or greater value. So if I were to sell my property for $1 million, and let's say I have $100,000 of closing costs, well, my net sales price is $900,000. I need to purchase a property equal or greater to $900,000. But wait, what if I have a loan on this property? Let's say I have a $500,000 loan. So I will only have $400,000 in cash. This is where clients sometimes get confused. They think, oh, just because I only get $400,000 in cash, not $900 in cash, $400 in cash, I only need to spend $400,000, right? The answer is no. I need to spend the $400,000, but still buy equal or greater to $900,000. What about the rest? Well, I will need to come up with the money however I can. Where I get this $500,000 does not matter. I can get another loan. I can come out of pocket for the difference, or a combination of the two. However I get the money does not matter, as long as I spent the $400,000 cash and buy equal or greater to $900,000. Now, let's talk about partial exchanges. Partial exchanges is what happens if I don't spend all that money. I need to buy for $900,000. I only buy for $800,000. I will have left over of $100,000. What do I do? Well, ladies and gentlemen, here are your options. That's it. Don't spend $100,000. Get that money back and you will pay taxes on the $100,000. That's okay. It doesn't disqualify your entire exchange. You only pay taxes on what you don't end up using. So for clients that are worried about it, if I need to buy for 900, what if I only buy for 899? It's not the end of the world. You get that $1,000 back, you pay taxes on $1,000, whatever your tax rate is. You defer the majority of your taxes, you just have a little bit left over to pay. Or number two, you can spend that $100,000 on another replacement property. Because remember, ladies and gentlemen, you can buy more than one replacement property in a 1031 exchange. You can sell one and buy multiple. The third option is use it in an improvement or construction exchange. You just bought an $800,000 property. Does it need a little bit of work? Maybe. You can spend the whole $100,000 on it. Any capital improvement, new roof, new windows, new kitchen, new rooms, ADUs, new pool, whatever you want, landscaping if you want to. Any capital improvements will work. But what happens if you don't spend all that money in a capital improvement? You have the $100,000 left over. Let's say you spent $80,000. Well, that remaining $20,000 at the end of your exchange, you'll get that back. You pay taxes on that $20,000, whatever your tax rate is. Again, not the end of the world. You end up paying what you don't use. So, ladies and gentlemen, when I explain this to my clients, this is the question I often get. Wei Ming, why can't I just use my gains? If I had net $900,000 and my basis was 500, my profit is only 400. Why do you tell me I have to use 900,000 when my profit is only 400? Well, think of it this way. This is how the government looks at it, like a cup. At the very top is your basis. At the very bottom is your capital gain. In order for you to start spending your profits, you have to spend your original money first, your basis. And only after you spent your basis do you start to spend your profits. Let's take the example of $800,000, all right? If I buy something for $800,000, I'm basically using 500 of my original money and then 300 of my profits. This is why if I only buy a property at $800,000, the remaining amount of $100,000 will be subject to capital gains taxes. Well, Wei Ming, if that's the case, can I just tell you I want to keep some of my original money? Right? Why would I want to spend all of it? Just give me some of my original money back. Well, unfortunately, that's not how the government looks at it. The way the government looks at it is if you want to take any of that money from the sale of your property, you take your profits first before you can take your original money. So that way you get taxed on whatever you take out first. Ladies and gentlemen, timeline for the identification. How much time do you have for your 1031 exchange? From the close of escrow, you have 45 days to identify potential properties to buy and a total of 180 days to close on any of the properties you identify. Here's a question I get asked all the time. Wei Ming, can I get an extension on my timeline? Answer is no. I cannot give you any extension. Nobody can unless it's the IRS. The IRS will issue an extension for your 1031 exchange if the area that you are selling or buying are potentially impacted by a natural disaster. As you may have seen, California experienced large amounts of rain and a big rainstorm recently. a lot of the counties in California are affected. Therefore, the IRS has issued an extension on their website. What does that look like? Well, the extension is until May 15th. If your day 45 expired, it's on January 8th or after January 8th, then your day 45 got extended to May 15th. If your day 180 is supposed to end on January 8th or after January 8th, it has now been extended to May 15th. So the amount of time for the extension, it varies. And the best way to check is to go on the IRS website, as they will often update those and post any extensions due to natural disasters. The government will not give you an extension just for you. If you can't find a property, they will not give you an extension because of that. If your financial situation changed, well, they will not give you an extension for that. It's typically natural disaster that affects a lot of people. Then they will post it on their website. Now, ladies and gentlemen, day 45 is extremely important for your 1031 exchange, because that's when you let me know what properties you're thinking about buying. It's your deadline. It's your client's homework. I need to know the address of those properties by day 45. I don't need to know before then, but I do need to know by day 45. After day 45, you cannot make any changes to your list of properties that you're thinking about buying. You can make whatever changes before, but not after. Well, Wei Ming, how do you identify properties and make that list of replacement properties that you're thinking about buying? Well, there are 3 rules I can choose from. Not all of them, not a combination. You pick one out of these 3 rules to use. The first rule is called the 3 property rule. This lets you identify up to 3 properties of any value. This is typically used for clients that are not looking to buy more than 3 properties. Especially in places like California, I see this a lot. They're not looking to buy more than 3. They might be looking to buy 1, maybe 2, but you can identify up to 3 properties of any value. The second rule is called the 200% rule. It allows you to identify as many properties as you would like, but the combined value of all these properties cannot exceed 2 times what you sell for. I'll give you an example. If I sell my property for $1 million and I use a 200% rule, I can pick as many properties as I would like, but combined together, all these properties together cannot be more than $2 million in my example, because that's 2 times what I sold my property for. Now, $2 million, that may not even be 2 properties in California. Definitely not 2 properties, more than 2 properties in the Bay Area. Typically, the 200% rule is usually used when or if I might be buying out of state. It'll be more bang for my buck, if you will. I can buy in a state where properties could be $300,000. That way, I can pick up 5 or 6 properties if I wanted to. Last but not least is the 95% rule. This rule allows me to identify as many properties as I would like, no limit to the value, but I have to buy 95% or more of the value of all those properties, or my whole exchange fails. Typically, I see this with a portfolio deal. where a seller is going, you either buy all these properties in the portfolio or I don't sell it to you at all. So this is extremely risky for people that might be saying, hey, I only want to buy all 4 or all 5. You have to be sure that you're going to end up buying all these properties, because that can potentially impact your exchange. Now, ladies and gentlemen, I understand that was a lot of information that I just gave you. But if anything, here is one thing I want you to take away from my presentation. I want you to take away from this the pros and cons of a 1031 exchange that you can see in numbers, and you can show your client the numbers if you want. In this example, I'm selling my property for $1 million. And again, these are numbers I've been using throughout my presentation. It's a $1 million sales price. My adjusted basis is 425, and my profit or gain is 575. Now, let's say I take the average 33% tax rate. Well, if I do a full 1031 exchange, the only thing I'm paying is my closing costs. I don't have to pay my taxes yet. I'm deferring my taxes. So what ends up happening? I will have $900,000 I can use in real estate. What are the pros and cons? Well, let's start with the cons first. The cons is, ladies and gentlemen, your client can only buy real estate with this. They can't buy stocks with it. They can't go and buy a car with this money. They have to buy real estate for $900,000 or more to defer all their taxes. Well, what's the good thing? The good thing is I have $900,000 in real estate. I didn't pay any taxes in order to get that. Not only that, I have $900,000 working for me in real estate. Let's just say, for example, I get a 5% return on $900,000. That is $45,000 every year. Let's just keep that in mind for now. $45,000 every year. Now, let's look at a situation where I'm not doing a 1031 exchange. Everything is the same. The only difference is I just pay taxes and my closing costs. My tax is almost $200,000. At the end of the day, that only leaves me with a little more than $700,000. That's not a lot compared to 900. If I'm going to be buying real estate anyways, who's going to win that offer? The 900,000 or that $700,000? Well, of course, the $900,000. Now, here's the thing. Oftentimes, I get clients that would say, Wei Ming, okay, I only have 700,000, but what if I put it in stocks? What if I get 7% return on my stocks? That's great. That's more than the 5% you get in the real estate. In real estate, that's $45,000 a year. In stocks, that's $49,000 every year. But in order for me to get that $49,000, I have to sell some of those stocks. That's number one. Number two, I cannot refinance stock. In real estate, if I want to get cash out, I can refinance that property. No problem. Doesn't matter if it went through a 1031 exchange, I can still refinance that property, pull cash out. What I do with the cash? Well, what you do with the cash is up to you, or whatever your lender limits you to. But not for stocks. I can't refinance stocks. So, ladies and gentlemen, this is quantitative information in numbers that you can clearly see the pros and cons of doing a 1031 exchange. Again, ladies and gentlemen, if you help me to sell my property at $1 million, who is more likely to help your client find that new property? A new agent or you, because you understand the 1031 exchange? You understand how much they need to buy for. Let's take an example. Jerry has referred me clients in the past, and all Jerry was doing is introducing us. I will walk your client through this process. I will put all this information onto an email. And when Jerry looks at this, Jerry's thinking, oh, I'm helping my client sell for $1 million. And this 900,000 is how much I need to help my client to buy for. I now know what I need to do for my client. That's it. That's all you have to do. If you know your client is looking to buy more real estate or another piece of real estate, ask them, have you considered an exchange? If so, talk to Wei Ming. See if he can help you with a 1031 exchange if you qualify. Now, ladies and gentlemen, I talked about this split treatment, and I want to go over this very briefly. This gets a little more advanced, but I see this quite often. A lot of times, as a real estate agent, you're going to get that client that's going to say, Wei Ming, I want to sell my property, but I know I have some profits, right? If I have to pay any tax, I don't want to sell at all then. You're going to get that client. If you haven't gotten that client, you will get that client in the future who will absolutely not sell if they have any taxes to pay. Or you're going to get that client that's looking to downsize as well. Well, what can your client do? What can you do? Or what can you show them so that they understand the situation? Well, in this example, let's say I still have that $1 million property, but instead, let's say I bought it for $400,000 and my profit is $600,000. Well, in a normal transaction, if this is my rental property, I just need to do an exchange for the $1 million minus closing costs, right? But what if this was my home, my primary home? I have $600,000 of gain. Well, if I'm married, I know I can take up to $500,000. That still leaves me with $100,000 I have to pay taxes on. And well, guess what? As the client, I'm going to say, I don't want to sell. I have taxes to pay, then I don't want to sell. Then you lose out on that sale, ladies and gentlemen. Well, what can your client help themselves to prepare? Well, if I know I'm going to sell in the future and I know I'm going to have $600,000 profit, I'm going to do this. I'm going to rent out the bottom half of my house to my sister, for example. I will live in the top half. I will rent out the bottom half. When I sell this property, everything is divided in half. So the top half is worth 500,000. The bottom half is worth 500,000. The basis split in half, 200 each, so that the top half has a profit of 300,000. The bottom half has a profit of $300,000. If I'm married, I can take up to 500,000. So that means the top half, it's tax free. Well, what about the bottom half of the house? Well, I can 1031 exchange that. The value is 500,000. I just need to do an exchange for $500,000. The other 500,000 that goes in my pocket because it's my primary home, and I can use that money to downsize. Ladies and gentlemen, it does not have to be 50-50 in this case. I could have made it 25-75% or vice versa. Whatever percentage equals to the square footage. Your CPA will ask for the square footage. But in this scenario, what am I doing? I am able to downsize because I'm getting older. As a client, I may be getting older and I want to downsize. This allows me to downsize and also buy an investment property on the side to give me some rental income. So, ladies and gentlemen, a 1031 exchange can be extremely useful in many situations. Again, all you have to do is send the client to me, talk to me, and I can see what benefits a 1031 exchange can be of use to them. Now, ladies and gentlemen, that concludes the presentation I have for you today. If you have any questions at all, I am more than happy to take questions now. Feel free to type out your questions in the chat box, Q&A, or if you're listening via your phone or on your laptop, feel free to unmute yourself and ask the questions directly. Did somebody unmute? Okay. All right. Well, it doesn't look like we have any questions at this time. But ladies and gentlemen, if you do have any questions at all, please feel free to call me on my cell phone, text me, or shoot me an email. My cell phone is the best way to reach me. Again, any questions at all, you want me to talk to the client or run some examples and scenarios with them, I am more than happy to do so. All right. Well, ladies and gentlemen, thank you for having me today speak on the 1031 exchange topic, and wish everybody a happy new year, and thank you again for having me. All right.
Okay, thank
Take
you,
care.
thank you, thank you.
Yes.
Hello, thank
Okay,
you.
thank
Happy
you.
New Year.
Happy New Year, thank you.
Yes, sir. Charles, did you have a question?
No, I just want to say thank you to you. No, I have no questions right now.
Okay, no problem. Thank you very much, everybody. You have a nice
Sure.
day.
You too.
Take care.
Okay, bye.
You too. Thank you for coming.